It's nice. Yeah.
So the syndication is designed, even though it doesn't have monthly cash flow to the investors, they get an 8% pref and they get 70% of the net profits,
Mhm.
which is double-digit returns.
I would like to take a 10-minute break and then 3, 2, 1.
How do you have the ability to analyze stocks? Welcome to the Generations of Wealth podcast. I am your host, Derek Dombeck. Today's guest, his name is Yoder, lives in Ohio, multifamily investor, has an incredible story. And before I bring Lee on, again, I always like to just thank you for being a part of the Generations of Wealth family and for being here. Anything that I can do to help you, don't hesitate to reach out. You can always go to derekdombeck.com. There is a box there now where you can get information and set up a time to talk with me. So trying to make it as easy as possible for you. And with that said, let's go have an incredible conversation with our guest. And without any further ado, here is our special guest all the way from Ohio, Mr. Lee Yoder. Thank you so much for being on a Generations of Wealth show.
Glad to be here, Derek. Thanks for having me.
Lee, would you just start us off? Tell us a little bit about yourself and kind of your journey, and then we'll jump into an awesome conversation.
Absolutely. I was a physical therapist. So went to school for a long time. They make you get your doctorate now. So 7 years of college. Became a physical therapist. Was enjoying that. Wasn't like in love with it. I wasn't real passionate about it. After my first job, got into home health physical therapy, got on with a company out of Cincinnati. I didn't really know that much about them. I should have known more about them before I signed on with them, but I came on as a physical therapist. But this was a startup staffing company in the healthcare space, so that's why they brought me on as a physical therapist. But most of what they do is like direct placements and doing staffing, which not important. But anyway, it was because it was a startup company. I kind of rose pretty quickly because they're looking for leaders in the company, not because I was killing or anything. And I became a clinical director. I'm managing all the therapists in the field, so I'm not doing physical therapy anymore. I'm managing therapists, PTs, OTs, speech therapists, and I'm doing sales. I'm helping grow this division within this startup company. So it was a very entrepreneurial feel, and I loved it. I mean, I did not miss doing physical therapy at all. I loved that work. I didn't even know kind of what to call it or how to explain what I loved about it because I'd never thought about doing something like this. I guess I knew it was like business and kind of building a business or helping build a business. And I just love that. But after about 2 or 3 years of that, I started to feel like I wasn't going to stay at this specific company long term. A lot of your listeners, Derek, know like just climbing the corporate ladder can, this was pre-COVID. So this was like, man, to prove yourself to the company, just be in the office as much as possible. And my wife and I were starting our family at times, so 2 young kids, and she's telling me, "Hey, just remember, whenever you work overtime, I'm working overtime. Would love to have you home." And so I started waking up like real early in the morning, like 4 o'clock in the morning, trying to get work done. So then I wouldn't have to stay as late, but like my bosses were like, "Well, that's cool. Yeah, you're getting extra work done. Yeah, you still got to stay here longer." And I was moving toward a promotion, and I asked the VP of the company, I'm like, "Man, can I still leave at 5:30 if I get this promotion?" He's like, "Well, no, because now you're going to be over recruiters, and like a lot of them are staying until 6:30, so you need to stay till then," which makes sense. I get it, but I'm like, man, I don't think that's where I want to be. Like, I love work, probably too much sometimes. I like to work, but I like to be able to control it. That's why can I get up at 4 in the morning and do work when my kids aren't up? So I'm working hard, but I'm not missing more time with my family. So I started looking around there, started networking, started talking to people, reading some books, read Rich Dad, Poor Dad, as so many do. For me, that was like definitely a light bulb moment, like it is for a lot of people. And what it said to me, Derek, was like, there's another game that a lot of people are playing, not a lot, a small percentage, I think, but that some people are playing. There's this different game. And from what I was learning about myself and what I liked and how I'm wired, I thought, I think that's more the game for me. And what that meant was like, maybe, again, I didn't know, but like maybe entrepreneurship, maybe trying something of my own where I can work really, really hard at it, but kind of control it because it's my own thing. So started exploring. My dad's in construction, so I grew up around construction. I love math, love Excel, spreadsheets. So the more I kind of learned about real estate and what that might look like, the more I thought this might be the path for me. I had a buddy at church that was in it full time. He said, "Hey, can you get more flexibility around your job where you could kind of do real estate on the side?" Well, at that job, no. I mean, I'm headed toward a promotion where I'm going to have even less flexibility. I got to be in the office even more. But man, if I go back to being a home health physical therapist, I had a lot of flexibility there because I just get patients to my phone. I can see them kind of whenever I want. I mean, there's a certain amount of time I need to see them, and it has to work for the patient, of course. But like for me to get a day off was nothing because I was paid per visit. So my company doesn't care as long as my patients get seen on time, and they're only paying me for the visits I do. So that's what I ended up doing. Went back to doing home health physical therapy. This was in 2016. In 2017, I flipped a house. So get just kind of doing this on the side while working full time as a home health physical therapist. 2018, kind of flipped a duplex. Didn't even own it for a year, but had some renters and saw that proof of concept of having renters versus just flipping a house, making some money, and then you got nothing. The year after the duplex in 2019, we bought a 16 unit. These are all local. So all like just north of Cincinnati where I live, between Cincinnati and Dayton. That 16 unit went well pretty quickly after. I got an 8 unit and then I got a 10 unit. Spent a whole year rehabbing those, renovating. They were heavy value adds, and did another flip during that time. That portfolio went well. I was working with a third party property management company. Those went well. By 2020, Derek, I was like dying to go all in on real estate. I fell in love with it. I loved it. Did not want to do any more physical therapy. Just wanted to go all in on this. So fortunately, because of the COVID stimulus boom, I don't know much about your story, Derek, but if you were invested, you know what I'm talking about. I mean, everything, like all my properties almost doubled because of, what our federal government did, and governments all over the world just printing money to fill the gap of the COVID shutdown, and that just all went into financial assets, went into real estate assets. And so my stuff doubled. So I thought, man, I got an opportunity here. I got a ton of equity now. I think I could sell my whole portfolio, have enough to put in my savings and give me a runway to go do this full time, like to support us for a few years. So I convinced my wife of that because the first dream I sold her on was what probably all of us do. Like, you hear it on all the podcasts. Hey, get a portfolio and the passive income from that portfolio will replace your income. And I was probably halfway there at the time. And I just couldn't wait any longer. So because of the equity that we gained, I was able to sell and take about 10 years worth of the cash flow I was getting. So just rough numbers on those, like, what was that, 34 units? I was maybe making 30 grand a year. I just did joint ventures and partner with family and friends on those. So I was maybe making like 30 a year. And yeah, we were able to do like 10 times that just by selling them. So put all that in a savings and give me like, several years of being able to just live off of that while we're making it full time. And so at the end of 2020, I quit my W-2. My wife had already quit hers. She stays home with our kids. She homeschools. She works in the business with me now. But we had no W-2, had to go get our own health insurance. So pretty scary. But I was willing to do it. I was all in. And so since then, we've been buying kind of bigger and bigger multifamily and bringing in more and more investors. So we syndicate now. We bring in, 30 to 40 investors each deal. We try to buy 100 units at a time. We own just under 900 units now in kind of Western Ohio, Northeast Indiana, and we manage all those ourselves. We started property management about 3 years ago. So built a property management company, probably have 25 employees on that side. Yeah, man, that was long-winded. I haven't told that story in a while, so maybe too many details, but I'll stop there, Derek.
So you haven't done much is what I heard.
Yeah.
No, there's a lot of questions I have in that, because the first one is, you mentioned health insurance, and I had golden handcuffs for years, and that was one of the big ticket items that we were so afraid of. Yep. And the reality is, when I looked at the cost of buying our own health insurance, it was one flip a year or half a flip a year.
Yeah.
But when you had the 2,000 hours a year that you were spending at your job to go full time, making another 20 grand to cover your health insurance or whatever it is, isn't really all that scary.
Yeah. Right.
But it's hard. It's all mindset.
Yeah, it is. It is. It's just different than what everybody else is doing, right? I think that's what makes it hard, is like, everybody has health insurance through their employer. I mean, it feels like everybody. Of course, there's a lot of people that don't, but I mean, for the most part, people have health insurance through their employer. They have Medicaid or Medicare, or like, the Obamacare plans. I mean, that's kind of similar to Medicaid in some ways for some people. But anyway, yeah, you're getting insurance through somebody, not just yourself going out and finding it.
Right.
Most people. Yeah.
So that was the first thing that I guess I wanted to touch on. The second thing
Yeah.
is, so talking about syndication and bringing in, private money,
Yeah.
we can unpack that. But what I liked that you said, and I want to dig into a little deeper, is you were partnering from the beginning, and sounds
Yep.
like, with friends,
Pretty
family, or
close.
whatever.
Pretty close. Yes.
And that's a double-edged sword too, right? Getting
Yep.
involved with family
Yeah.
has some nuances.
Yep.
But I see so many people that just jump into partnerships, which are marriages, essentially, without having a proper structure, contracts,
Oh,
documentation,
yeah.
what happens if things go bad.
Yep.
What did you do back then? Was it just in the beginning, was it just handshakes, or how did you put these partnerships together?
No, I did. I was part of. I think by that time, I was at least going to some meetups, maybe finding some stuff through Bigger Pockets. I ended up joining the RIA, the Real Estate Investor Association of Cincinnati, going to those meetings. Got connected with a real estate attorney and just paid a little bit to have an operating agreement drawn up. Said, hey, here's what we're going to do. Just partnering with my in-laws. They're going to do this. I'm going to do this. We're splitting 50-50. Can you write this up? And we both signed that because, yeah, man, that was a fear of mine, especially my first partners were my in-laws, my wife's parents. And I did not want, I didn't want to ruin our relationship, obviously. And you just don't you don't want to have those conversations later. You just want to kind of talk about it up front. Hey, let's just go ahead and do this. Let's make this legal and just kind of get everything written down, so that we understand things. So there's no questions later. Yeah. So we did, use an attorney and just write a pretty simple operating agreement, but at least kind of laid things out.
And I think that's really good that we touch on that, because
Yeah.
the problems that come up in the future, COVID as an example, nobody knew that was going to happen.
Yep.
Well, if there's a death, a divorce, an illness, one partner's not carrying their weight or whatever, it's really hard to sort that out after the fact when you aren't necessarily happy to talk to each other or can't talk to each other in the event of a death.
Yep.
And I meet so many people that don't want to have those hard conversations in the beginning. So
Yep. Yep. No, I think that's well said. I would always recommend people just, man, write down more than you think you need to, talk about more than you think you need to. Yeah, it's like getting married and not talking about whether you want to have kids or not. Those are conversations you should have beforehand.
Well, I can tell you that the last few joint ventures that I looked at doing with people, we would record a phone call and then transcribe that, put it into chat, and just tell chat or whatever AI you want to use, draft an agreement from this, and
there you go. It's pretty easy. Yeah.
And not that you don't want to get that double checked, but it spits out 95% of what you need.
Absolutely. Sure.
And it actually does a far better job of thinking of things than we would.
Yeah. Oh yeah. Yeah. No, absolutely. Because it's able to access thousands and thousands of legal documents, right? So it kind of knows what needs to go into it. No, I love that. I love that strategy. And then it's transparent. You're saying, hey, we had this conversation. You remember it. I transcribed that, put it it's very transparent. Here's what I did. If you forgot to say something, then it's not in here because, this just went off our conversation. So if you want to add some stuff, let's add some stuff. It just puts it all out there at the beginning. That's really good.
Well, yeah. And step number one, having the conversation, throwing it into AI and it spits it out. Then all parties go through and redline it and say, okay, this is what we want to tweak.
Yep.
You either do that manually or you go right back into AI. But at that point, and we're talking, this can be done within an hour.
Have
a conversation, spit it out. It's very, very handy. So,
yeah, that's a good one. I like that.
So then, okay, moving forward, you obviously jumped all in with, as you mentioned, I think 100 units or more kind of. Is that in the timeline, is that getting harder and harder to find now versus 2021, 22, 23?
Yeah, absolutely. Because It's harder to find. I mean, it's harder well, I don't know if I should say it is harder to finance. But it's harder. It's just harder to make the numbers work, in my opinion, because while prices are down, they're not down enough to offset the rise in interest rates, is what I find. And we're looking for cash flow. And when you're looking for cash flow, your purchase price means a lot because that's going to dictate how much debt you have to get and how big the loan is you're going to be paying back. And your interest rate matters a ton because, if you're paying the bank 4%, it's kind of easy to make a nice spread above and beyond that 4%. But if you're paying the bank 7%, like that's what I'm trying to pay my investors. I mean, we're trying to pay them 8, but it's close. So that's a way different world. So yeah, I have a ton of trouble finding good deals today. And it's been that way for, the Fed started raising interest rates in spring of 2022. So we're 4 years outside of that. And, in 2022, it was still, you could still be pretty aggressive, I think, in your thinking about where rent was headed. But around here, that changed in 2023. So we're going on 3 years of like, no, if you're being smart, I don't think you're projecting a lot of rent growth, if any. And that's difficult. It's difficult to pay, to be aggressive and pay a high price when you're thinking, not expecting a lot of rent growth. Meanwhile, expenses are going up. So that's really hard to underwrite. Stagnant revenue and increasing expenses and high interest rates. So, and again, prices have come down. I mean, people aren't as crazy as they were in 2021 and 2022, but not enough in my opinion. So yeah, we're having a lot of trouble finding good deals.
Are you buying value add properties that need updating or renovation?
For the most part, yeah. I guess what I'd say, Derek, like I'd say around here, you can buy a nice B. I wouldn't buy A class. Don't really look at them. But like if I were to buy a class B property, nice apartment building built in 1990s, 2000, early 2000s, you're probably going to buy it at, maybe a good deal. You can find it at a 6.5 cap.
Mm-hmm.
But again, you're financing, and I mean, you can get Fannie Freddie maybe today at like 5.5. So there's some, positive leverage going in there. But that's just going to be like okay cash flow. Meanwhile, your value add, you might still have to pay that same cap rate. Sometimes it's even lower because they want you to pay them for some of the upside. So, but if I buy at a 6 cap on that value add, but then there's a clear good path to get to a 7 to 7.5. Well, then I am doing better than just buying that kind of stable 6.5 cap. So I just said, yeah, I guess we are still trying to find something that tells us we can push the value higher, push the NOI higher, that would get that cap rate higher, because what makes sense to me with no value add is like buying at an 8 cap or buying at a 7.5 cap, or at least 7 cap, like with rates of 5.5, but nobody's doing that. So yeah, I think typically, to me, you need to find some way to push NOI. So you're pushing your, operating cap rate so that you're operating at higher, positive leverage, with that operating cap rate being above the interest rate. So we're typically finding something, but I will say nothing like what we were looking for in 2021, 2021, 2022. I mean, we were like, man, give us as many units to renovate as you can. Like we want to do as much. Now I don't think it makes sense. And honestly, I don't know that it did back then. It just felt like it did because you just couldn't lose. So it felt like doing a lot of unit renovations was working because you were doing it and rent was going up. But I really think that was just the market. I think there were guys not doing unit renovations. Rent was still going up, but it felt really good to do it. But today it does not. Just spend a lot of money, and then you're maybe pricing people out where it's like, actually, I'd rather just not spend money and just stay more affordable. So that's more of what we're doing, but it still feels like you need some value add. And so we're still renovating units. It's just when people move out. I mean, we still feel like, okay, rents are low here. So when people move out, we are going to renovate. We're going to we're going to do less than we were doing 21 and 22. We might keep cabinets, replace the fronts, things like that, instead of replacing all the cabinets, keep the appliances. But we still want to see like, I don't know, $100 rent bump when we do that, or 150 when somebody moves out and we renovate a little bit.
Well, and the other side of that is if people have a quality place, they're probably not going to move out for $100.
Right.
But
I would think so. Yeah,
right.
Exactly.
But the other landlords that are letting their properties get run down, and your competition, that's their choice. But there's so many of these people that bought these properties at 4 cap, 5 cap that can't afford them now. They had bridge financing or commercial loans coming due. And this is where we're going with the syndication part of this conversation, right? It's like, okay, and I'm curious how you do it. If you're raising on a syndication in a junior lien position behind a bank that's got a bridge loan or a balloon coming up, how do you hedge that to protect the syndication?
Yeah, we always try to do 5 years of fixed rate debt. We haven't done, the bridge, haven't done adjustable rates. We want to lock our rates for 5 years. So that helps. I feel like 5 years is, for us, typically like plenty of time. We should be most of the way through, feeling like we're 90% of the way through kind of our value add plan within 3 years. So that gives you another 2 years to feel like you get right time. Now, I'll be honest with you. I mean, we, bought a property in May of 2022. We've kind of been ready to refinance or sell if it makes sense, for a while now, but like, it's just not been a good time. It's not been a great time to sell, and it's obviously not a very good time to refinance. The rate we got in May of 2022 was, I think, 4.38. So let's call it 4.4%. We're gonna refinance at least a full percentage point higher than that, at 5.4, something like that. So it's hard to want, we're not going to refinance early. We got that until next May. So we got to, but we could. The value is high enough now. We could sell if we couldn't refinance. But there's no, I guess, when there's no foolproof plan. But our properties cash flow well. So when that's happening, you got money. We do have good reserves for these properties. So you just try to, you want to have them in a good spot. And you can't overpay. I mean, that's the thing with those cap rates and getting positive leverage. I mean, when you do that, when you buy at a good price and the cash flow is there and there's an opportunity to increase cash flow, even if rates go up, like you can be in a good position. So yeah, right. And when you put 20, 25, 30% down, right there, okay, we already have that much equity at least we could get a new loan, even if it doesn't mean, I mean, we were trying to do a cash out refinance to pay our investors back. If we do it 5 years, we'd like to pay it all back if we can, but at least, somewhere between half and all of it back. So, if things don't go well and interest rates are a lot higher, maybe you can't do that and you're just getting a new loan and maybe paying a little bit back. Hopefully for us, that's the margin of safety that we have. Nothing's foolproof, but so far we've been able to, I think giving yourself at least 5 years is the biggest thing. I mean, we've moved before that, but we at least have 5 years if we need it.
Yeah, and what I liked about how you described that is, investors, it's a relationship, and anybody investing in a syndication is, for the most part, in my opinion, investing in the manager more so than the project.
Yes, right.
And I've been raising money for a long, long, long time, and for me, the communication with your investors is the key, because things are not always going to go smooth.
Right.
But, if you're ghosting your investors, or, there's some operators out there that they know that this project's going downhill and they just stick it to the investors and they move on. They stop fighting the fight. That's what puts a bad taste in people's mouth. When you go to raise money, if they've been jaded because of a bad investment, it's really hard to make them understand, I'm not that same operator. I'm not that same company that you lost money in the past.
Right. Yeah. Yeah, it's unfortunate, but that is definitely a part of the industry today. There's been a lot of losses for sure.
And that's kind of where, from a syndication standpoint, like I have a syndication right now, and we're raising for a redevelopment of a resort in northern Wisconsin. And that project, it's different than what you do because it's a redevelopment. There's not cash flow coming in from it, so it's tail loaded. But we're also not putting any kind of debt in front of the syndication. So
that's nice. Yeah.
So the syndication is designed, even though it doesn't have monthly cash flow to the investors, they get an 8% pref and they get 70% of the net profits,
Mhm.
which is double-digit returns. Well, enough people have been inquiring, and I'm going to make this super simple on all of you that are listening to the show. If you have any desire to work with me, whether that is a transaction that you're working on that you need help structuring, if you'd like to buy a deal that I have for sale, if you would like to sell me something, whether it's real estate or a business, happy to talk with you. Or if you want to be a financial partner in one of our real estate transactions, simply go to derekdombeck.com. On the homepage, there will be a tab and there will be a web form for you to fill out. Check the boxes that make the most sense for what you want to do, and you will get directed to schedule a call with me, and let's have a conversation. Let's see what we can do to work together. So look forward to hearing from you, no matter what it is that I can help you with. Again, go to derekdombeck.com, fill out the web form, schedule a call, and I will talk to you soon.
Yeah.
In the backup plan to that is, we don't know what these houses, once it's redeveloped, are actually going to sell for. We have projections like anybody, but because we don't have that institutional debt, we can talk to our investors and say, you know what, the market in 2027 is doing this. We're going to lease these houses out for a year or two, and here's our plan B. And we don't have that lender or that bank knocking on our door saying, your balloon is due,
Yeah. Yeah.
But that's very different from what you do. And it's not that one is better than the other. It's an investment, right?
Well, yeah, that's a great way for people to diversify if they're in maybe, kind of more of a cash flowing syndication, and then, something that's not cash flowing, but bigger on, probably bigger opportunity on the back end. But man, the way you guys are doing it, you've probably heard that quote, like the only way to lose in real estate is to be forced to sell. Mm-hmm. Because over time, time kind of heals all wounds. I mean, you're going to be okay over time because our government is going to continue devaluing the currency. So assets are going to inflate because of the devaluation of the currency, and people always need a place to live. I mean, it's and whatever real estate you're in, there's going to be cycles, but it's going to come back. So it's not always the case. There are buildings that have to be torn down. Mm-hmm. I guess at least you still own the land in most cases. But in most cases, like, as long as you have time, and that's what you're explaining there, Derek, is like, you guys are going to have time. You're going to have time. You're going to have options. You're not going to be forced by somebody. And man, sometimes doing it that way, certainly it can decrease your upside, but man, it decreases your downside tremendously. And I hope people are thinking more about that today, because they're seeing that, yeah, there's real downside in real estate. There's syndications where the equity went to zero. I mean, the biggest funds in the world are gating withdrawals right now because they're struggling, because they own a bunch of office, but also even multifamily. People are losing giant multifamily properties. Blackstone is struggling. Apollo, like these giant companies. There's downside risk in real estate. So people would be wise to not try to hit home runs, but to go for some good returns, but ones where the downside is really capped, where guys are saying, hey, we're not taking on debt, so we have options, we have time. That's important.
Well, and I've said that I started this in 2003, and I've been up and down, and my regular listeners know the stories. Don't pass up the base hits waiting for the home run.
Yeah.
Take the base hits, right, because they all add up to scores.
100%. Yeah, they do. Yep. That compounds. You get momentum, and a lot of times when you swing for a home run, you strike out.
Yeah.
Whereas you're swinging for base hits, you don't strike out near as much.
Well, so you told me you live between Cincinnati and Dayton, so I'm going to tell this story real quick. I got my ass handed to me in the crash of 07, which my regular listeners know as well. And so I think it was around 2009, I bought a house sight unseen in Dayton, Ohio.
Okay.
For $7,000.
Nice. Wow.
Sold it on terms on eBay for $34,000.
Oh.
Collected payments on it for about 2.5 years. And then the guy I sold it to, who was, dare I say, an investor from New York City, I had never set foot in a property ever. But so he made payments to me. I had huge returns in the 2.5 years he made payments to me. He renovated the house 3 different times because it got broken into and stripped.
Oh my
And but
gosh.
my payments came in every month. Um, and ultimately, he went to jail because he was running a Ponzi scheme, taking advantage of elderly folks in
Wow.
his regular business. And he defaulted, and I let the property go to the city, and they ultimately tore it down because it was not worth foreclosing. Foreclosing in Ohio is a very long process.
Huh.
But we
Didn't
had
know
all of
that.
our money
Yeah.
back,
Yeah.
many times over.
Yeah.
So that's my experience in Dayton, Ohio.
Wow. Good for you, man. It was part of your comeback story.
Yeah, it was,
Yeah.
those
That's
numbers
cool.
sound crazy to even talk about today.
Yeah. Oh yeah.
And that same street in Dayton, Ohio, I'm assuming properties there are worth, 6 figures now, but you also got Bill
Maybe,
Oldham.
unless were you on the west side? Were you on the west side of it?
Um, I can't even remember the street name
There's
anymore. That's
there's some parts of Dayton that they're still tearing down houses and need to tear down more. So if it was in that pocket, it may be good that they just let it go and tear it down, and they're probably doing more of it. But yeah, if it's another area, sure, it could be worth 100,000, 200,000 today.
yeah, that's thousands of transactions ago, and it's
Yep.
all a blur.
Yep.
But it's amazing, like you mentioned, 5 years. I'm pushing 23, 24 years, and it seems like yesterday.
Yeah. Oh, I'm sure. Yep. It goes by so fast.
Well, I got a really hard question for you, Lee. What is one question I should have asked you that I did not? And it can be about anything.
Well, I think, with maybe multifamily in general, I think maybe for some of your listeners, they might wonder why multifamily, and maybe this is prescient right now because multifamily has had a tough few years. So I think a question that I ask myself, and I think our investors should be asking us and your listeners maybe is like, is it still a good investment to invest in multifamily? And is it good right now? And I would say I still think it is. I think multifamily is one of those asset classes that is always going to be good. So I think, if you're in it, if you're interested in it, you should always be looking for deals. I think, single family homes to me are just always going to be a good investment. But to think that the market cycle doesn't matter is foolish. I mean, it does. It really does. I mean, there's, I think in Florida, single family homes are losing a lot of value right now. So, you time that kind of stuff wrong. But at the same time, like, if as long as you know that, you could be the one right now buying those at a 30-40% discount. And then there's areas of Florida that aren't going down at all and aren't going to because they didn't build that much or whatever, and population's still growing. So I think multifamily is like that. I think it's a great investment. There's a few things about it. I mean, one, the people always need a place to live, and that is overused because, yes, while people do need a place to live, they can live in their parents' basement, so they don't have to live at your apartment. So population can be going up and occupancy can be going down because more people are bunking up together, right? I mean, two girls don't both need a 1-bedroom apartment. When times are good, they get a 1-bedroom apartment. When times aren't good, they share a 2-bedroom apartment, and your occupancy just went down by 50%, right? If those just based on those two residents. And then also, yes, people need a place to live, but they don't have to pay $2,000 a month. I mean, so just because people need a place to live doesn't mean you're going to get whatever rent you think you're going to get. But all that being said, people do need a place to live, so it's not going away. So as long as you're in a good area that people want to live in, it's really hard to like drop below 90% occupancy or at least 80. So again, like if you're doing it right, financing is really good in multifamily. Our government supports it. So Fannie and Freddie give better than market interest rates, better than market terms like amortization, things like that. So that is very helpful. Now, prices reflect that, and we have to pay too much for multifamily because of some of these things, but it's not going anywhere. So I think it's a tried and true investment. I think it's worked for hundreds of years. I think it's still working. But absolutely, you have to mind the market cycle. And this has been a really hard time to be in multifamily. So I would tell you, like, the stuff that we own, I mean, we're very fortunate to be in the Midwest. We're very fortunate in a lot of ways that we did buy well, that we put good debt on. So our stuff's fine, but it's not as great as I thought it would be. So it has been it's been tough. We sold, one last year, one earlier this year. We did well, but not as well as I thought we were going to do. So it's a tough time. But that being said, I think, it's better. It's a better time to buy now than it was a few years ago, because we've kind of been sideways to down. So I don't know if we're at the bottom. I tend to think we're not, but I know we're not at the top because we were there and we're not there anymore, right? So yeah, it's kind of a long answer. I think it's always a good time to be in multifamily, just like I think it's always a good time to be in real estate. But man, you have to be smart. You said it earlier, Derek. I mean, this, if you're going to invest with somebody, the sponsor matters more than the deal for sure. You need somebody that's got a good track record, got good integrity. But I think everybody should be getting into real estate investing. I think multifamily is a great asset class, always, but I think you got to be smart, choose your spots. And this is a time to be careful and be patient because it's a tough time to find a really good deal. Interest rates could go up more. Rent could go down more. Those things could definitely happen. I would not be surprised at either. That's not my base case. I think rent's going to stay flat for a little bit longer. And then I do think it's going to work its way back up, but I don't think it's going to be this year. It may not even be next year. I think interest rates are going to trend down, but I'm not betting on that. That I thought that was going to happen in the past year, and it kind of bounced around and just went sideways, right? So yeah, I guess that's what I'd say is a question like, is multifamily still a good investment? I think it always is, but I do think this is a tough time, so I think you got to be careful in it.
Well, what I took away from that is, United States is typically spoiled rotten when it comes to
100%.
the size of homes that people have gotten used to. Instead of a 1,000 square foot ranch, everybody wants 3,000 square feet.
Yep.
But you look at most other countries, people share housing, family members, generations because of cost.
Yes.
And I absolutely see the United States going that direction. But then the other point is, I've always been the ones that don't follow the herd, right? People are getting out of multifamily, get educated, look at the good deals, but there's opportunity. Single family homes, I coach people around the country. Florida, you're right, the market is going down fast, but if we can go and buy free and clear properties or sub 2 30-year fixed financing at 3-4% rates, we can turn that property around and put somebody in on terms as well. There's opportunity, and that's the whole point.
100%. Yep, I agree. Always opportunity.
Well, I'm going to let you go after you tell us, what is Threefold Real Estate Investing Podcast all about?
Well, it was a similar podcast to yours. I actually don't do the Threefold Podcast anymore.
Is it still available out there for people to listen to?
Yeah. You can go on my website, threefoldrei.com, and it's still there. It's about multifamily. I think our tagline was faith, family, and real estate. We're big on our faith. I'm big on family. I kind of talked about this at the beginning. That's what really led me into real estate was I love the work, but my faith and my family are more important to me than work, even though some days I don't act like that, but most days I do. And I wanted to set it up that way. So that's why I love real estate investing. That's why I love what you're doing, Derek. That's why I did the podcast was I'm like, man, more people need to get into this. Again, you read Rich Dad, Poor Dad, and you're like, there's people playing this different game and it's a much better game to play. And like, not that everybody needs to do it full time. I'm guessing you coach a lot of people, Derek, that do it on the side. I think that's great because what I found is getting into real estate, like I don't, especially early on, I wasn't making a ton of income. So it'd be great to have a job where you're making some income, but man, poured into real estate. So anyway, that's what my podcast was about. We're just trying to get people educated like you're doing, Derek, and get more people into real estate. Cause I think this country is amazing. I mean, that's why immigrants come over and just crush it in real estate. You see, I feel like especially people from India come over and they're like, I can buy this stuff. Like anybody can just buy this. Yeah. And they crush it. They do so awesome in real estate because America's amazing. But a lot of even Americans don't know about it. Like they don't understand it. And that's what Rich Dad Poor Dad did for me was like, go do this. Why would you not go do this? So I was trying to educate more people on that. I'm glad, guys like you are continuing to do that, Derek, because it's out there for everybody. I mean, it's not easy. It's not overnight, but it definitely works. I mean, if you've got time and you've got a long-term view, it's really hard to fail over 20 years. It's really hard to not do really well over 20 years. I mean, it's set up. The government's going to devalue the currency and everything you own is going to go up in value and you're going to benefit. Instead of people that don't own anything, they're only hurt by inflation. My renters, inflation only hurts them. Everything costs more and they don't own anything. People that own, even whether you own the stock market, you own real estate, whatever you own, yeah, your grocery bill went up too, but your house is worth more. the other houses that you own are worth more. The apartments that you own are worth more. Your stock market, your 401k is up a ton. So the asset holders in America benefit from what our government's doing. You might as well understand that and play that game, because people that don't own anything are only hurt by what our government does with inflation.
100%. I couldn't say it better, and I think that's
Yeah.
where we'll wrap it up. Well, Lee,
Right.
thank you so much for being on the show. I know you had mentioned before people can look you up on LinkedIn. You threw your website out there. So just appreciate you being on the show.
It's great being on. Thanks for having me, Derek.
So for everybody else, you know the drill. Go out there and share this show anywhere you can. Appreciate you longtime listeners. And if you're brand new, go back and listen to the archive shows. And until next time, go live your vision and love your life. See ya.